Ever wonder how some Boston investors scoop up deals lightning fast, even when banks say no? I'm talking about hard money lending, the tool that can either make or break your next investment. Today, I'll show you how the pros use it, where the risks really hide, and exactly what to watch for so that you don't get burned. Let me tell you about the first time I used a hard money loan. I was staring at a deal that banks wouldn't touch, a 3-family in really rough shape, but full of potential. I jumped in, got the funding in days, but I'll never forget how fast the fees and interest started piling up. If I didn't have backup plans, that first deal could have absolutely sunk me. If you're new here, I'm Jarrett Lau, founder of Profitable Properties Boston. I own 50 plus cash flowing rentals in the greater Boston area, and I've helped dozens of investors scale up, even when banks and conventional lenders say no. So why do Boston investors use hard money? Because in this market, speed is everything. The best deals go to the buyers who can move in days, not weeks. Hard money lenders look at the property's value, not your credit score. So that way you can buy distressed homes, fix and flips, or do value add rehabs that traditional banks are going to avoid. But let's be real, hard money is not for everybody. If you're just starting out, don't have reserves, or you're not 100% clear on your numbers, this can be a one-way ticket for disaster. But for experienced investors with a team and a plan, it's one of the most powerful tools that are out there. Here's the basics. Hard money is a short-term, high-interest loan from a private lender. Typical rates are going to average anywhere between 10 to 12% on interest, and you'll pay 1 to 3 points up front, and a point is just 1% of your loan as a fee due at closing. Loan terms are short, usually 6 to 18 months, and most lenders are going to cover 70 to 80% of the purchase price and sometimes 100% of your renovation costs. But they want to see a solid down payment and proof you have funds for rehab, taxes, and insurance. So let's do the math together. Say you want to borrow $500,000 at 11% interest, 2 points, that's $10,000 up front, and your monthly interest payments come out to about $45.83. Over 6 months, that's nearly $28,000 in interest plus $10,000 in points. And that's if you're on schedule. Go over and your profits get eaten up fast. A lot of beginners miss this. Hard money lending is like a taxi with the meter running. The longer you hold the property, the more you're going to pay. If your contractor stalls, the appraisal comes in low, or your refinance takes longer than planned, you're the one on the hook. Let's make this real. One of our clients found a 3-family in the Dorchester area listed for $700,000, needing about $120,000 in renovations. No bank would touch it. The hard money lender agreed to fund 75% of the purchase, or $525,000, plus 100% of the reno budget, paid out in draws. The investor put down $175,000, paid the $14,000 in points, and got an interest rate of 11%. 6 months later, the renovations were done, units released, and now the new appraisal came in at $950,000. They refinanced with a conventional bank, paid off the hard money, and now collected $2,800 per unit in rent. But not every single story ends this well. I've seen investors get stuck, renovation delays, unexpected repairs, or again, appraisals that came in lower than expected. Suddenly, their 6-month loan becomes a 9-month headache, and those extra payments erase their profit. Or worse, they lose the property to the lender. Top mistakes that I see: no backup exit strategy if the refinance stalls, underestimating renovation costs, not budgeting for holding costs and fees, borrowing from a hard money lender without reading the fine print or vetting their reputation. If you're considering hard money, here's how to do it right. Always have at least 2 exit strategies. Build a detailed renovation budget with a buffer. Vet your lender, read the reviews if they have them or get references. Get everything in writing. Draw schedules, interest rates, fees, penalties, and don't start unless you have the reserves for the unexpected. I get these questions all the time. Can you get hard money for owner-occupied properties? Usually no. It's for investment deals only. Can you use it for out-of-state properties? Sometimes, but my suggestion is to stick with local lenders who know your market. What if I can't finish the rehab on time? Some lenders will extend, but expect to pay extra fees and higher rates. Is it possible to get 100% financing? Rarely. If someone offers it, read the fine print and make sure you really understand the risk. If you want my full hard money deal calculator, a lender checklist, or personal intros to trusted Boston hard money lenders, comment hard money. in your city below, or just DM me directly. I try to reply to every single message, and please do subscribe for more no BS investing strategies. In my next video, I'll be breaking down all the hidden costs and the gotchas that you need to watch out for before signing a hard money loan. I'm Jarrett Lau with Profitable Properties Boston. Keep leveling up your portfolio, and I'll see you in the next one.